Well, I'll kind of touch on the basics of what we'll go through today. And I think a lot of you guys probably have HELOCs, so you're working that strategy of, throwing your income in there, pulling your expenses out. So, we've noticed, and I've actually noticed this myself over the years, is it's a lot harder to track your budget when you're doing that, right? You kind of get loose with it where you're just kind of like, oh, I have access to money. I'm using my credit card for expenses, so it can be tricky to manage that versus, like the way that I used to do things is we just had a checking account, savings account, right? And we used our savings account as like a emergency fund or opportunity fund. So easier to budget and manage things that way versus using the HELOC. So, if you guys have had HELOCs for a while, maybe you can chime in and kind of jive with that. Has it been easier or harder to manage your budget?
Harder. I'm
Harder?
confused. I put in the text, but I'm pretty new. I'm
Okay.
pretty new. I'm very confused and I'm nervous a little bit. I'm trying to work through it.
Yeah. Okay. Do you use like spreadsheets at all?
I am using a spreadsheet,
Okay.
but
Yeah.
it's something I've created. But
Yeah.
as you just heard me say that I'm selling a condo. I had one account that just I managed everything through that. That's coming to an end, so that's going to be less confusing with that one. And I'm
Yeah.
consolidating because of my meeting with Christy and Shane. But so far, right now, it's really hard to track what's going from what, and I am it's crazy. It's crazy.
Yeah.
But it's a
Yeah.
spreadsheet that I created myself. Um, help with the help of ChatGPT. They're really guiding me through the spreadsheet.
Gotta
Yeah.
love chat.
Yeah, but
That-
it's taking forever. I mean, it's like I don't know. I'm not a math person, and also I'm not a spreadsheet expert, so I have to keep asking. But here's the thing: I am really learning how to use Excel for sure.
yeah. That's good. Yeah. I've always used Excel, so I keep track of, I don't do it as much as I used to. Like when I first started utilizing the HELOC strategy, I would keep track of like, you know, income. I'd have a column for income every month, a column for expenses, like normal monthly expenses, a column for miscellaneous expenses, stuff like that. And I would track it pretty meticulously. And like over the years, I've kind of gotten away from that. Um, but yeah, I think it's important to kind of go back to the basics sometimes too, especially if you're using the HELOC strategy. So yeah,
I think for me, it will just be I have to be hyper vigilant and understand how everything is working until I understand it fully, and then I can calm down. But I'm not calm. I am telling you, I am not calm.
okay. Well, let's try to get you calm.
Take a pill. Take a chill pill, Deanne. All right. So, Christy, do you want to say a few words before I dive in?
Yeah, so a couple of things, and Adam's right. Like I think that sometimes it's challenging. The call that I just got off of just before jumping on here, we were talking a little bit about this, that it's really challenging when you've got lines of credit and not being tempted to use them. So I can't tell you how many times we meet with people and they're like, "Oh yeah, I've got this much left over." And then we go through the numbers and I'm like, "Wait, how do you have that much left over? It looks like you're spending more than you're making." And so being able to go through a budget, you guys, on a regular basis is something you really need to be doing.
Yeah.
Now, even if you are using a credit card, then have that credit card be something that, like on mine, I have Capital One, and it will actually tell me and give me a breakdown of the categories of where I'm spending.
Yeah.
And so sometimes that's helpful to be able to know, like, what are you actually spending money on and where is it going? Because it's easy to just consume it if it's there. And so if there's one thing that I agree with Dave Ramsey on, it's that. When it comes to budgeting, if you only have what you have and you don't have more, it keeps you from overspending. The tendency with the HELOC is to then go, okay, well, I have it, so I'm just going to do this project and I'm going to do that project. We're going to go on this vacation.
Mhm.
And it's like if you try to give yourself a parameter and say, okay, if it gets below this part, then I can go on my vacation. Like then it might make that a little bit easier to manage. Or if you need to say, hey, I'm going to keep some in a savings account that's a high yield savings account just to help me to manage my balance of my HELOC going down, then give yourself the training wheels if you need them. And so sometimes people need those training wheels. If you're not paying off your credit cards on a regular basis, I can promise you that you are spending more than you're making and you need to start
Mhm.
looking at your budget. And so this is one that you guys have heard us talk about this before, but this is a website that I like a lot of their calculators on here. So I'll share this and then I'll put it in the chat so that you guys have this. But this is it's calculator.net, and this is the budget calculator. And so one of the things that I like about it, it's going to give you a kind of a pre-filled amount in here, but this sheet, it kind of takes you through all of the different categories. Now, when you get to the bottom and you hit calculate, it's going to give you a breakdown, and it's going to say your debt to income ratio is good, so it's going to tell you what the percentage is. It's going to tell you a breakdown of what you're spending in each of the different categories so that you can see what's going where. You guys, I love that this already flags it and says the recommendation is for you to be saving for the future 15% or more. And so if you're not saving that, it's going to give you this little message. And it's going to also tell you right now you're saving 12% of your income. Now, college savings for your kids, by the way, that does not count as your savings. So put that under your kids column, not on your future. So don't get those confused, because if you're putting money aside for your kids and you're doing that at the cost of you not putting aside for your own savings, then you want to make sure it's properly accounted for so that you can see a breakdown of what's going where. So that way, if something is out of whack, then you know how to address it. If you're looking at it and going, okay, how much am I putting toward transportation? How much am I having go toward living expenses and meals and eating out? It helps you to know where you might need to address, like where the bleed is coming from. Now, this also will give you in here, it will tell you some kind of basics about how much you should be spending toward, like transportation costs should be 15% or less of your income. Other debts and loan payments. So it kind of gives you some parameters that are also helpful so that if you're trying to figure out where am I overspending and where do I need to cut back, this is a good tool to do that. So I'll put this in the chat so that you guys have it. But it's something that is recommended to do something like this. Whether you use this one or not, feel free to use something on your own, but it still is good to be able to just know percentage of what's going where. Now, don't hit save because you don't have an account here, nor do I. And so you're going to just hit print when you're done. And then that way you can just save this as a PDF so that you have that, to share with us if you want to, if we're working with you, or to just have this for your own records so that you kind of know and can keep on track. That's a good budgeting tool to be able to help you to do that. So
I have a hand raised, Christy.
Oh, yeah.
Christy, I just went to the calculator.net as you mentioned,
Mhm.
and I'm looking for which one you're using. There's quite a list of calculators here.
Yep. So if you're on financial,
Yeah.
then it's actually going to be in this other section, and it's at the very bottom, budget calculator right here.
Okay, thanks.
So there's other good ones in here too. So these are, if you're trying to pay off debt faster, then there's good like debt consolidation, debt payoff calculator, credit card payoff. There's a lot of really cool calculators in here. The retirement ones, these are obviously the more traditional route, which is, something, feel free to use this too, but these are a little bit less reliable as far as our standpoint on some of these kind of things, but it still is good to be able to kind of play around with all of these that are on here. So,
Thank you.
and I will put this in the chat too. Okay. But pay attention to the percentage of what you have going where. So that's something that's helpful to be able to just kind of understand. My dad and I were actually having this conversation yesterday. Take a guess. I'm just kind of curious what you guys would say. How much do you think of your income you have that goes toward debt service? Meaning your mortgages, your credit cards, your auto loans. What percentage do you think is going toward debt?
They're saying too much.
That's the correct answer.
Yeah.
Okay, any other guess on a percentage of what the average person has going toward debt service?
Guess on what other people, not me. I can guess for everybody else.
The average person.
Average person, I'm going to say 60 to 70%.
We're seeing 50 to 70 on here on the chat.
Okay, so now this is another thing that we see all too often is that sometimes people have way too much of a house for their income that they're in. How do you know if you are? So if you go to get a loan on a mortgage, what's the debt to income ratio that they want you to have just for housing? Anyone know what that percentage is?
28.
Okay, yeah, 28 up to 42. Depends on the type of loan. Okay, now there's housing part, which usually should be about 35% or less, by the way. So now housing would be your principal, your interest, taxes, insurance, those all combined. And then some calculators will actually even take what they think your annual maintenance would be on a house based on what it is, and then include that in there. So if you have more than 35% of your income or a third of your income that's going toward housing, you might need to be looking at downsizing because you may be in more of a house than your affordability is for you. Now, having said that, not everybody has that much of a loan available on there or has a loan for that amount. So there's that part that's going to be different. But look at how much you're actually paying on it and then ask yourself if it's out of order. If it is, then start looking at what you can do to kind of, either increase income, decrease expenses. I used to do debt and credit counseling, so I was always trying to help people to avoid bankruptcy. And I would go through somebody's budget and say, there's really only two ways to solve this. Either we increase income or we decrease expenses. Which one do you want to do to avoid bankruptcy? And so I think sometimes in today's day and age, when we have so much on credit lines and everything else, we don't know when we're heading toward bankruptcy. And so those are some things that help you to be able to know those parameters. Now, that's the housing expense, is that 35% or less. That's kind of what you should be trying to stay within. Now, if you add your other debts, meaning other payments, so credit card payments, auto loan payments, anything that would basically be a payment that would show up on your credit report, that's when they would go sometimes into your total debts and everything. They usually want that to be 45% or less. Sometimes it's even 40% less, 40% or less. Sometimes it's 45, sometimes as high as 50. If you have anything more than that, you are in deep, deep trouble, and you need to be like doing a serious deep dive on your budget and being able to take a look at where you can cut back, or you really are heading toward bankruptcy. If you've got way more of what your income is going toward debt service than what you have in lifestyle or in being able to save, that's like a big, huge red flag. So take a look at what percentage of your income is going toward debt service and toward just lifestyle in general, and then that puts it in perspective too. All right, Dad.
All right. So, I want to help you think long range. One of the problems that I see a lot of is people don't think long range at all. And I want to help you think that way. And specifically, those of you that are in your 20s, 30s, 40s, and 50s, I want you to do something that's going to make you happy in your 70s and 80s. Okay? And so I want to go through this with you right now to kind of help you to see how we see things. And this is more along the lines of infinite banking right now. Okay? So I'm going to illustrate over a 30-year period of time. And I'm going to start with somebody who is 35 years of age. And I realize that most of you are not that young anymore, but 35 years of age. And I'm going to start with somebody who has no assets to start with. And I'm going to give them an income of, look at this for fun. I'm going to give them an income of $25,000. Now, over the next 30 years, that $25,000 is going to give you a compound. If you were able, the first year, you're $25,000 average over all the way, you will have had $750,000 go through your checking account. Most of you are making more than that. So I'm going to use this number right here because I like round numbers of $100,000. Think about this, you guys. If you're 35 years of age over the next 30 years and you're making $100,000 a year, $3 million is going to go through your checking account. Take a minute and let that sink in. $3 million. You're going to write checks for $3 million. Now, if I was to ask you, how many of you feel like you're millionaires? Most of you would say, well, I'm not. Well, over this period of time, over the next 30 years, if this guy never gets a raise, he's going to be a millionaire. He's going to be $3 million. So the problem is not money. It really isn't. It's how we use the money. And this is classic Nelson Nash. Okay. Now, if we're getting $100,000 a year, let's assume that he's going to get some kind of an increase. And I'm going to use 3% because that's what, having been a personnel manager, most of you that are working for somebody else get, I would call it a cost of living adjustment. for basically 3%. And when you do that, now look how much money is going to go through your account. $4.7 million. That's how much you're going to write checks for. That's just until you're 65 years of age. And we probably should go farther than that, but I want to have you think long range. The first year you're making 100,000. Over that entire period of time, you're going to be making $150,000 average, 158,000 average. But the last year, your income is going to be $235,000. Now, I'm older than everybody on this call, and I can tell you that I look back on what my original income was when I was fresh out of college, and it's been higher than all these numbers that are here. So I've had a lot of money go through my checking account. The problem is not money, it's how to hold on to it. And here's the problem that we run into, and that is taxes. Let's start out with taxes. And the average person on this call is paying 35% in taxes. Now you say, I'm not paying 35%. What I mean by that is 35% of your income is going for taxes. Now that's state taxes, federal taxes, telephone taxes,
Yeah.
property taxes, etc. All the taxes. And I
Sales
used
tax.
to have a one page, and then it flew over. It overflowed into 2 pages of all the taxes that we're paying. And if you take a look at all the taxes we're paying a lot. So taxes are about 35% of your income. Okay. Now, debt payments, Nelson Nash wrote a book, and he was saying that 34.5% of the average person, and I'm going to make it 35%. That's what's going out of your income for debt payments. Please understand that's not a 35% interest. We get hung up on looking at interest, but 35% of our income is going for debt. Now, by the way, if we didn't have any expenses at all, this is what this curve would look like. This is an uninterrupted compound interest curve, if you want to look at it that way. But then we have taxes, and taxes will take a hunk out of that. These are the taxes down here. So the taxes are going against us. So the first year, you're able to save 65%. If that's all you did was pay the taxes, 65,000 would be going for saving. If you could do that, wouldn't that be wonderful?
If you had
But the
no
prob-
lifestyle,
Yeah.
you didn't need to eat.
Yeah, if you didn't eat. So all you, as a matter of fact, I'm going to
That's
give
why I
you
had ramen.
I'm going to give you the Jim Kindred philosophy on economics. The first thing you need to do is never spend any money, because if you go out and buy a car, guess what? You've got to maintain that car. You got to pay taxes on that car. You got to put it in a garage. You have to wash it, and all of those things because you have a car. The interesting thing about this discussion, Christy, is your mother and I were talking about this just yesterday, and we said, we've got 2 cars. Why don't we get rid of one of them and Uber everywhere we go? Now, if you stop and think about that, by the way, that's exactly what Uber wants you to be thinking, and the self-driving cars, because, I mean, if you think about what it costs to drive a car, it's expensive. So the trick is to never spend any money in the first place. Now that doesn't make you a friend of your family, but think about it. Every time you buy something, you're never through with it. So the debt payments now are basically 35% is going for debt, and you can see what that's doing here. So now instead of having 4.7, you've given up. I can't do the math on that real quick, but now you've got 1.4. Okay, so guess what? Notice what it says right here. You've got 13.81 years of future income. Okay. But we're not done, because you got lifestyle. And the lifestyle is going to be about 20%. And that means you're saving 10%. Now, how can I reduce your taxes? Which one of these do you want us to reduce? A lifestyle? Most of you don't want to reduce your lifestyle. So let's take a look at taxes. Can I do anything to reduce the taxes? Yes. Christy's nodding her head. Yes. Christy, what would you do to help people reduce their taxes?
Well, for one, there's different things. A lot of times we're taught the traditional route, which is to say, okay, one way to reduce taxes is by saving for retirement and putting into a 401k. And then you're getting a tax reduction now in the hopes that the tax bracket in the future is going to be lower. So, I mean, that's not one that I would necessarily do. Although if you're getting a match, you absolutely should do that. And so that'll help to reduce some of the taxes. There's also an HSA account that you can put into that gives you a tax deduction now. So these are some of like the low-hanging fruits that are things that we normally think of. There's also ways that you can, if you are a business owner, that you can lend to your business and reduce your taxable interest that way, taxable income that way, I mean. What other things are you looking for, Dad, specifically? But yeah,
Okay.
there's a lot of different ways you can reduce taxes now.
Okay, how about if I could reduce those taxes by 10%? And 10% of 35 would be 3.5. So that brings me down to 31.5. Watch what this does. 31.5, and then we'll talk about how we do that in just a second. But if I did that, if I reduce my taxes down to 31.5%, now I've got more. Oh, I forgot to add an earnings rate, didn't we? Hold on a second. So this $100,000, if we're going to be able to save 10%, we want to have that money earning something for us. So let's put a 4% rate of return on that. Okay. Why am I using 4%? That's what you would get inside your life insurance policy. Okay. But look what this does. This gives me a compound. I've got compounded now. Instead of 8.4, I'm down to 1.1. That's a little bit, that's 8.2, 8.9 years of income coming for you. But how can I reduce your taxes by 10%? Some of you are having money that you're putting into a savings account that's outside of your life insurance policy. And guess what? You get a 1099 on that. You're paying taxes on that.
Mm-hmm.
That's a simple little thing. You shouldn't be having a separate savings account. Now, I run into people from time to time, they're having a savings account so they can pay their premiums on an annual basis. Okay, don't do that. Pay your premiums monthly. Okay, and have that money going into the policy. Because why? Because that money that's inside the policy is tax free. Okay, you're not paying taxes on that. Let's talk about debt service. What can I do about debt?
Really quickly, sorry, time out on that one. So really quickly, so one of the things, those of you guys who are clients of ours, you hear us say this already, but those of you who are not yet working with us quite yet or at different stages, so this is something that is a good refresher either way, but we feel like that money that's sitting in a checking account, who's benefiting off of that? Okay, not you, right? So the bank is. So the bank is making money off of your money when you have it sitting in a checking or a savings account. So we want to flip the script and have that be you. So we feel like that money should be residing in one of two places. So excess money, that is. Rather than sitting in a checking account, we either want it to be paying down a debt or we want it to be building up an asset, like the policy would be an asset. The debt might be your HELOC. It might be the credit cards that you're trying to pay off, whatever the case is. We want it to be in those places, not sitting there in a checking account earning 0.1% and you're giving the bank a free loan to use your money while the meantime you're paying out 7% in debt. Okay, that's what we're talking about there. So if you have it sitting in a checking account, any interest that you do happen to earn, which might be like $3 by the end of the year, you're going to get a 1099 on that interest that you earned. So don't get a 1099 on interest you're earning. Put it to work instead.
But I was thinking that should it, I'm sorry, should it go into a first position HELOC and there, but then that would deny you of the tax credit that you would get from that. I mean, so that's the other thing I'm considering. I haven't done anything yet because I still have the first big piece with the condo thing, and then we'll deal with that. But is that a place to put it? The first position HELOC?
And yes and no. I mean, I would rather it go there than sitting in a checking account. I would rather it go into the policy rather than having it on a first position HELOC if you're getting a tax benefit on that first position HELOC, meaning that you're itemizing on your taxes. So that's kind of a part 2 conversation, but yeah, good question. All right, Dad, sorry, I didn't mean to interrupt you.
No, you're fine. You're fine. So let's take a look at the debt payments. So again, Nelson is saying at 34.5%. I'm going to up it to 35% just to help it do the math. So that 30, so by the way, when I reduce your taxes, that means more money can go to savings. That's how we end up with more money over here. Okay. But now debt payments, this is all about infinite banking. Nelson preached this over and over and over again. And that is the first thing you need to do is slay the snakes and dragons. Now, what does he mean by the snakes and dragons? That's sending money to somebody else to pay off a debt. In other words, you've got a debt to somebody and you're paying that interest rate. That interest is going to somebody else. Run it through your policy and reduce your payments, reduce your debt. Watch what happens if I could get my debt down to 0. Watch what this does. 4.1 million. How do I get my debts down to 0? I buy my own debt. What do I mean by buying your own debt?
Paying, you take a loan on your policy and pay that back and put your savings account, use your checking or savings account to pay back that debt. Is that what you mean?
What I'm saying is that that if you owed somebody $20,000, let's say, on a car, for example, this is not my best example, but I'm going to use it because everybody has a car. If you still owe $20,000 left on your car, maybe what you want to do is buy that debt, take the money out of your policy, borrow it against your policy, so you still have a debt, but now you go and you pay off the car, and now the $20,000 is coming back to you, and you're making the payments back to yourself. At the end of that, here's the very important question that I think that a lot of us are missing, and that is after you've paid off a debt, where's the money? And think about that with your HELOC. I talked to a woman today, she's got like $75,000 left on a $300,000 house. So after that $75,000 is paid off on her HELOC and the house is paid for, where's the money? And don't tell me it's in the house because you can't go open the garage door and pull out $10,000. It's not in the house. People say that, but they're not being accurate when they're saying that. Where's the money? The money is in the bank or the credit union. Whose credit union and whose bank? The answer is not yours. And if it's not your bank, what difference does it make where it's going? So when you can, you should be buying your debt. Now, one of the misconceptions that I run across a lot is people think that you should be able to be completely, totally out of debt. Well, the only way you can do that is to never buy anything. And by the way, when you pay cash, I heard Don Blanton talk about this week, Christy. When you pay cash, what you're doing is you're borrowing from your future self. See, debt is a part of, whether we like it or not, debt is a part of our life. You cannot get rid of it. All you can do is decide who gets paid for the debt. And I want you to get paid for the debt. Does that make sense? Do you understand what I'm saying?
Really quickly on there, on that debt payment, put that back up at the 35%. So you see where it says below that, and then that has like an annual cost increase at 3%, kind of keeping up with inflation. Right below that, it says total costs. And it says 1.6 million. So we are sometimes so concerned about how much we're paying out in interest, like on a mortgage, but we're not looking at all of the other things that we're doing. If we can recapture that into our own economy, how much better off are we in doing that? That's the actual loss right there, which is that number below, that 2.9 million. So when you talk about being able to have a policy that allows you to then have it still be compounding and growing while you're using it to pay for debt that you're already doing in your day-to-day life, what does that do to expedite your retirement plan to happen sooner? Do you understand that? That is a massive amount. And so the more that we can recapture that and have something that be something that you can control. Now we still want to slay the snakes and dragons. We still want to live within our budget. We still want to be able to have our lifestyle. But is it different when we're paying debts back to ourselves and to our future policy and future retirement account versus having it be something that's completely just lost to us? Okay.
Yes, because your policy doesn't lose the value.
Uh-huh. And so now keeping in mind that the policy is still going to be growing and compounding while you're using it to help you to pay off the other debts and refinance, getting it away from somebody else and getting it into your own economy and into your own mix instead. And so that's the power of what the policies are allowing you to be able to do, is to basically say, okay, that debt service that's just being lost to me, what if I recapture that myself and let that help to amplify and expedite my whole retirement plan? You guys, this is not about rate of return. You look at that and say, okay, if I'm getting a 4% return on my money in the policy, that's terrible. Okay, but guess what is not terrible? Being able to refinance your debt and get a 4%, I think that's not terrible even a little bit, because that allows that 2 million that we saw a minute ago to then be going back into you and your future and your retirement. And how much does that expedite being able to retire when you look at the collective ability that it gives you? So that's where the power of this comes in. Now, even if you didn't ever use the policy for refinancing your debt, that policy, let me just kind of put this in perspective for a second. What you have in a 401k, if you had $1 million in a 401k and what you can spend out of it and have after tax is the equivalent of about 60% of that in a policy. Now, I need you to let that sink in for a second. If I have $600,000 in cash value in a policy that I'm going to have that provide me tax-free income, that's the same as me having $1 million in a market account. Okay, so guess what? My 4% rate of return doesn't need to be 11% because I'm not losing it to taxes. And I also have the ability to use it to help me refinance the debt. So even if I didn't refinance my debt, pretending I didn't use it to refinance my debt at all and give myself another 2.9 million by recapturing some of that, it still is going to outperform and give the same thing as $1 million. So what that means is you're able to retire sooner. You're going to have a better lifestyle when you retire, and you have more control and liquidity and use of being able to do all these different things like paying off your debt and refinancing it faster.
Christy, you just said something that caught my attention, which was you said a 401k that's a market account, which I understand that. But what about a Roth that's tied to the market? You're still getting that tax benefit, though. It's the same thing, kind of, as this. It's not at a loss. Is that right? That part I think is right, but I'm still hearing, I'm hearing that there's still more of an advantage to putting it in the policy over the Roth. Is that right?
Well,
And
and
here, excuse me just one second. And here's one of the reasons why, Deanna. The Roth IRA most likely is in the market. And you
Yes,
have
mine
to
is.
remember that part of most people only have a 2-year memory. We can think back, we can remember 2 years ago. But let's go back the last 20 years. The market has been going up and up and up for the last 20 years. We haven't had a major correction in 20 years.
It's
Guess
due.
what? We're going to have a correction. I don't know when it's going to be. Nobody can tell you. Trump is working on getting things resolved in the Middle East right now, maybe. But if we go to war, watch what happens to the market. And the market giveth and the market taketh away. The closer you get to retirement, the less you want to be in the market. And that's, the Roth, everybody thinks it's about interest rate and rate. It's all about rate of return. What we're trying to show here is it's about recapturing lost opportunity cost. Let me talk about that just for a second. See this, I got rid of everything else except the taxes. So here's the total cost of the taxes over that 30-year period of time is $1.498 million is going to go to taxes. But that's not.
Oh, sorry, Dad, one second.
I accidentally muted you. I'm sorry.
Mhm.
You're still on mute.
You're still muted. We can't
All
hear
right,
you.
now you're not.
I'm sorry, Jim. I got click happy.
Watch it. I just said the best thing I've said all day. Come
I
on,
thought that was
Jake.
me who did that. Sorry.
So
I'm
don't
with
know.
you,
I
Chrissy.
read. I can read lips, Jim. I don't think that's what you're saying after you got muted.
So here's the actual cost. This is what you actually paid in taxes. But had you not paid those taxes, this is what you would have had at a whopping 4% rate of return, 4% earning rate. So that actually cost you 2.6. Here's one of the takeaways for today, guys, and that is this. The conventional financial wisdom is out there is all about the opportunity to make a certain amount of money. But there's something called lost opportunity cost. What does it cost you when you don't? What does it cost you? In other words, by the way, this was one of the things that I misunderstood for years when I first when I first met Nelson, because I thought lost opportunity cost was just an accounting error. It's not, it's real dollars.
Yes.
If I didn't have to give away
Yeah.
$1.4 million and I could have earned 4%, I could have earned 2.6 million. That's what it actually cost me. Same thing with your debt. If the debts are 35% of this guy's income, then I'm giving away it actually cost me 1.6, but the actual cost is 2.9. And then we had the lifestyle that's in here because you had to go to dinner and go to plays and do all this stuff. And by the way, I don't know of anybody who wants to cut down their lifestyle. These are the two things that kind of jump off the page at us. And this is where we want to spend our time. And this is what infinite banking is really, really all about, is not messing with your lifestyle. How much do you want to give away your lifestyle so you can put more money into the stock market? I don't want to do that anymore. Haven't for 26 years. But this is what it's costing you. So if you look at this compounding interest over here, if you didn't have to spend any money, that's what you would have had. But we end up with this. So everybody thinks, okay, let's get a better rate of return. And that, because I came out of the securities world, I thought, let's get a better rate of return instead of 3%, or excuse me, 4%. Let's get a 6% rate of return. Wow, that would make us look a lot better. Really? If you didn't have to spend these lost opportunity costs still eat up a large part of that. And by the way,
Really quick, Dad, when you hover over that where it says compound,
one?
on the far side, that 14.23 years of future income, what that's saying is if this person is doing this and they're saving 13.5%, and this is the way that they continue, that compound number is representing how many years of income you're going to have in retirement with that amount compounded. Okay,
Yeah.
so you guys need to let that sink in too, that when we can reduce down on taxes and debt payments by recapturing that using the policy, that increases everything. So you need to understand that side of it, that right now what's being lost to you is not being recaptured. When you have a policy, you can recapture a lot of that tax stuff, a lot of that debt payment stuff, and have that be the portion that we're making the biggest difference on. When you work with us, one of the things that my dad has had is a tagline that he's trained all of us on for years, which is that when we're meeting with you and we're going through your financial review, we're having as our goal to be, we want to give you more benefits and have you not spend any more than you're already doing. So in other words, we're saying, hey, let's keep everything the way that you're doing it, but let's restructure it in a more efficient way. So what do we mean by that? We mean, let's take the debt service and the taxes and let's work on those two categories and to be able to restructure how and where you're putting things to make it more efficient so that you can recapture some of that 4 million that's lost to you or 3 million that's lost to you, to be able to have that be where the difference is made up. Now, we're not saying you shouldn't come back on debts and lifestyle if you're overspending. That's kind of the first place that you're going to look at. But aside from that, there's only so much that you can do on your lifestyle. And so we want to be able to tackle the taxes and the debt payment instead.
So here's where the conventional wisdom is, and that is let's get you a higher rate of return. And back when I had my securities license, my basic pitch was I can get you a better rate of return. Put money into my mutual fund as opposed to that other guy's ETF or that real estate because I can get you a better rate of return. And the answer is maybe. But how much risk do you have to take to get a 6% return versus a 4% return? The answer is more. Now, and here's where the problem lies too, is those of you who have 401ks. I was looking at a woman today. She put in there as to I was doing her financial assessment, and she put down that she was getting a 17% rate of return on her 401k. Okay, well that's this year, but next year it could all be taken away, and the market goes up and the market goes up. You got a roller coaster going on constantly.
Goes up and it goes up.
Yep. And rate of return, rate of return is the rate of return is what the conventional wisdom is all about. What we're all about is how much money is spendable that you can actually spend. And we do that by working on avoiding the lost opportunity cost rather than trying to figure out how to get a better rate of return. And the rate of return, everybody thinks of average. Dave Ramsey is classical about this. He thinks an average rate of return is the same thing as an actual rate of return. It is not. He'll talk about getting a good 12% mutual fund. There's not a mutual fund on the planet going back to 1928, when the first mutual fund, 1928 was the first mutual fund, and there were two of them. The next year we had the crash, of 1929. But the first two mutual funds were in 1928. Going back to 1928, there is not a mutual fund on the planet that's paid 12%. They've averaged 12%, but that average does not mean what you're going to end up with. And that's a whole other discussion we probably ought to have another time, because actual and average are not the same thing. Don't get caught in that trap, because it's not a good trap to be in. So the takeaway for this basically is let's work on, the statement that I give people all the time is my job, my goal is to give you more benefits, more options, more control with less risk than you're currently taking right now. And we'd like to do that without taking any money out of your pocket. In other words, we're going to help you get more efficient. And that's what this is all about, is getting more efficient with the funds rather than trying to pick the winners and avoid the losers. We think it's a whole lot better to work on avoiding the lost opportunity costs. Make sense?
Hey, Dad, just out of curiosity, I'm going to have you do something really quick, if that's okay.
Sure.
So let's take the traditional route, which is how we would normally go about doing that. So if you took a market account, whether it's a Roth, 401k, brokerage account, really doesn't necessarily matter for the sake of this for a second. But let's say that you have, the highs and lows of the market. If you had an increase of like 34% on a positive side, and then you had all these ups and downs and roller coaster, and you took a 25-year history, and then you also had some lows that might be at that same 34%. You can have as high as 34 and as low as 34 and still have it average out to an average rate of return of 8%. Okay. So when you look at market accounts, you just need to understand that the average and the actual and everything else doesn't necessarily matter, even though they're giving that to you. What matters is how much you can spend. So there's kind of two routes as far as making money. You're either going to try to chase the rate of return and you're going to go kind of like that route, or you can say, okay, I want to take a more actuarial science route, which would be like if I gave you the option and said, okay, you've got $500,000, you can become a mortgage company to somebody and you can let them make payments to you, or you could put that in the market. Which one would you pick?
Another way to say it is, would you rather go to an ATM to get money or a slot machine?
Okay, now here's another question. What one would the bank pick? So think about banks. Which would they rather? Would they take their money and invest it? Or would they take their money and lend it and become a mortgage company to somebody? Okay, so there's lending and then there's the market. Okay, now think about what you guys do. Do you borrow money? Okay, so you're the lender. I mean, you're the borrower, right? And then another bank is the lender. So all we're saying is that make money off of your own money and have that be part of your kind of investment strategy. So if you have two different ways to do it, just understand that there's equal power in being able to have both of them that you can have as tools in your tool shed. But sometimes people only think that there's one way, which is to take risks to get ahead, because that's kind of what's ingrained in us. But if we look at how much we pay out to other lenders and we can become our own borrower and lender in the same transaction, that's what we're talking about, the power of being able to do, is to be able to say, hey, let that be your investment rate of return of what you're spending on things normally that's just being lost to you, and recapture that. So Dad, do me a favor on that debt earnings rate and put that in there as if it's 8%. Okay, now that 8%, now if we look at that compounded amount, Dad, put your cursor over that on the compounded down at the bottom on savings. Okay, now that just gave us 31 years worth of future income. Okay, so that's one way to do that. Now take that earnings rate and take that back down to 4%, which by the way, it's probably higher than 4%. I think you're being conservative on that, but that's okay. Okay, so that 4%, now instead, let's take that debt payment down from 35%. Now take that down to maybe 15%. Okay, now let's take a look at that compound, see where we're at as far as number of years. Okay, now we're at 40 years. You guys see the power in that? You have the option to do either or. You can try to chase a higher rate of return, or we can try to recapture some of that debt service. Now, if you have both going for you, great. Then that just gets you to retire better or sooner or whatever the case may be. But you have full range of motion. You have more power and control than you think. And right now, you having dependence on the other lenders instead of having the financial ability to be able to lend for yourself is creating that need to try to chase that higher rate of return, which is again that traditional route and that traditional path. All we're trying to tell you is that there's another way to do it. Now, we're not saying you have to take yourself completely out of the markets. We're saying just know that there's two ways to do it. You might want to take the best of both worlds. You might want to let the 401k or the market accounts work in your favor, but they're not really liquid and accessible for you to use. So being able to have the policy as well in the tool shed allows you to recapture some of your debt, give you some consistency, and give you some tax-free income, so that that way you can have the best of both worlds playing for you and you have more tools in the tool shed. No different than if you were playing a sports team, you're not going to play offense only. You have to play offense and defense. All we're saying is that you need to be able to change the rules of the game to have yourself be able to benefit more than what you're having the banks and lenders be benefiting off of you. You become your own best consumer and refinance your debt yourself and recycle that money to allow you to be able to have a better retirement, to have that happen sooner.
Hey, I want to do one more thing here, but real quick, and that is take a look at this. We've got inflation down here that we haven't talked about. What do you think inflation is going to do to this? I'm going to put in a 4% inflation rate, and guess what that does? It takes money out of everybody's pocket. This is a tax. People, you have to understand this tax, this inflation. Well, first of all, where does inflation come from? Where does inflation, what causes inflation? There's only one place it comes from. And it's not,
Government spending.
I'm sorry?
Government spending.
It's government spending. Exactly right. It's government spending. They're the only ones that can create inflation. And by the way, back when we were on the gold standard, before 1971, we had almost no inflation. In 1971, good old Richard Nixon took us off the gold standard, and it meant that the government could print money out of thin air, which they've done for years. And now your dollar is worth about 2% of what it was back in 1971. That's where inflation comes from. It's not because the evil, it's not the evil businessmen are charging you more. It's the government is printing more dollars that are chasing too few goods. That's what causes inflation. And there's not a thing we can do about it. Except get out of the way. Anyway, that's all I had. Christy, do you have anything else you want to talk about?
No, other than just to say that when I was saying before about like what you have in a market account versus what you have in a policy, is to help you to understand that you don't need to have, it's not always about how much you accumulate, it's about how much you can spend, right? So if you accumulate a ton, but yet you have a silent partner, which is the IRS and, you know, finance fees that are cutting into that cut of your pie, then understand that what you're left with is the important part that you're wanting to look at. So same thing with real estate. If you have real estate like a rental property and it's providing $30,000 a year in income, great. That doesn't matter if you can't keep any of that. If your costs and fees are eating up all of those profits and then you're upside down, then who cares what the income is that's coming in? So you need to look at and understand that with financial vehicles of all types, you need to look at what am I putting into something and then what am I taking out of it. That's your best rate of return barometer, not how much it can earn. Because if you have an account that you're going to earn and have it accumulate $2 million, but then you're going to lose 30% of it in taxes with Uncle Sam and then another 1.5 or 3% in fees, then how much are you left with to spend? That's the part that matters to you. And so understand that there's different vehicles that allow you to do that, and that what we're taught traditionally is probably the exact opposite of what's actually going on. And how do you know that's the case? Because insurance companies and banks are the two biggest institutions that make money hand over fist. And they're doing the exact opposite of what the rest of us are told to do. And so there's something flawed with that system, but we need to understand the reason why we're taught that is because who's going to benefit? Our silent partner, Uncle Sam and Aunt Iris, because they're going to take their cut and we're going to be left with what's left. We're taught to take risk to get ahead, and in order to get ahead, you have to take risk, and yet that's benefiting the government more than it's benefiting us. So just understand that there's different tools that you can use in the tool shed, and knowing which one to use at what times helps you to be able to understand and have comfort to know that you don't need as much as you think that you need. And number two is that you can recycle some of those funds to be able to allow you to both get ahead and save for retirement and pay off your debt. You don't have to choose to do one or the other. Let's do both at the same time. And when we can do that more efficiently, that means that you have a better economy, you have a better lifestyle for now and also in the future too. So we hope this is helpful. If there's any other comments on what you guys want us to cover on future sessions, let us know. If it's about general finance stuff, then we can cover that. So filling out that poll really is helpful. But we appreciate you guys being here, and we've got a few minutes left. So if anybody has any other last minute questions on this, that would be great too.
One more thing I would like to say on something that Christy just said real quickly, and that is it's not how much, I mean, in the conventional world, in the market world, the phrase is always, it's not how much money you make, it's how much money you keep. That's not, I mean, that's wonderful, but just because you keep it doesn't mean you can spend it.
Mhm.
Okay, and that's what we're talking about. How much money you can really spend is really what the number should be, or what you're looking for, not how much money, not how much money you make. It's how much money you're able to spend, and that is in while you're going up the mountain, but even more so as you're coming down the mountain in retirement. So hopefully this was helpful. We'd love to have you fill out that form for us, if you will, that poll. That helps us a lot. We pour over those after we're through. So please take a minute, and then we'll entertain any questions that you have. And Shane, I see we've got a whole bunch in the chat. Anything there that's burning that we should be talking about?
No, I think all the questions in here have been answered.
Okay.
There's someone that says crypto. I don't know where that,
Like, what are our thoughts on crypto, maybe?
yeah, maybe.
I have a little bit in crypto. I hope it goes up, but it stresses me out in the meantime when I look at it literally every single day on the app and then go, oh, I don't do well with the roller coaster ride. It makes me a little nauseous, but I do have a little bit in crypto, and so I tend to think it's going to go up, but again, it's kind of like any other market account. We can hope all we want to. It doesn't change our crystal ball on knowing what it's actually going to do.
What do we think about gold and silver? What a great question. Can I talk? Let me hit that one. I'll tell you what Kim Butler says, and Kim is one of my mentors, and she and I have worked together, and we've written a book together, and we've worked on a bunch of stuff together. But her comment is, "What's the dividend on gold?"
Nothing
the
because
dividend
it's nothing because it's sitting in your house in a freaking bar.
You hope it's sitting in your house.
Well,
Now, and by the way,
senator gets a hold of it.
so now one of the things about gold Nelson talks about Willie Sutton, and he says anytime you have any kind of money or assets collected, Willie Sutton shows up. Who's Willie Sutton? He was the bank robber, the famous bank robber from the last century, and he would rob a bank. They would catch him, put him in jail, and he'd break out and go rob another bank again. Somebody said to him, Willie, why do you keep breaking into banks? Why do you keep robbing banks? And he looked at him kind of funny. And he says, well, that's where the money is. So anytime you have money showing up someplace, and I would say this is especially true of gold and silver. So here's the question. Where do you hold gold and silver? Just tell me where it is and I'll come to your house. You see, if you're holding gold, I mean, Christy and I know of an individual who built a 17,000 square foot home, something like that, just a small little home. And in his closet, he built a circular staircase that went down into his vault, and that's where he was keeping his gold. Well, they made the mistake of having an open house, and people found out that he had that in his basement. What do you think that did to the security of the gold? And went out the window. Not the money went out the window, not the gold, but I mean, where do you put it in your bookcase? And the other problem with gold and silver is it takes up a lot of room and it's heavy. It's not like you can pick up and take off and go with it. In Utah, they created something called gold backs, and I got to show you one of those because we bought a bunch of those not too long ago. They look like dollars, except they're not dollars. They've got different images on them, and they're actually made out of gold, and they're thin, so you can use them. You can share them with other people. But the problem with gold typically has been if you want to buy a loaf of bread and you take down a $20 gold piece, it's not $20. It's now, what is it, $4,500? You know, and by the way, that's an indication of how much the value of your dollar has gone down. And by the way, one more quick thing. Money makes money when it moves. Matter of fact, here, I want to show you this, you guys. What did I do with it? Oh yeah, here we go. So this is, I don't know if you can see this. I'm gonna unblur my screen here if I can real quick. So can you see what this is?
Put it right in front of your face. We can see it. It's a water bottle though.
It's a water bottle, but if you look at it, look how it's deformed. Now I live in the desert. This bottle of water has never been opened, and yet it's losing water. How in the world is that possible? It's got less water in it now than when it was given to me. You cannot stop water from moving. Water will evaporate, it'll move. I used to work for a coal-fired a company that owned a coal-fired power plant. They had steel that was 3/4 of an inch thick that they would run water through and heat it to create steam to turn the turbines, and then they would reduce it down to water again, condense it down, and they would have this in a closed loop system that never saw the light of day. They had 21,000 gallons of water a day, an hour, 21,000 gallons of water that was makeup water because that doggone water would go right through the system. It would go right through the metal. How's that possible? You can't stop water from moving. And I would suggest it's the same thing with money. You can't stop money from moving. You put money into your house is all paid off. You think it's good and secure there? No, that money is moving. Where is it moving to? Inflation is eating it up. You can't stop money from moving. So money makes money when it moves. And what this is really all about, partially it's all about, is moving the money where you want it to be moving. Does that make sense?
And really quickly on a
Go
little
ahead.
bit of like the gold and silver and some of that. So sometimes people do gold and silver, do bonds because you're trying to hedge other things and the volatility of it, right? So traditional financial planning world, they say, okay, yeah, be able to hedge it and be able to do like gold, silver, some of that. Gold and silver, kind of from our viewpoint, like the physical gold and silver, you've got the spendability of it is really hard. You're almost better off. It's more of like a commodity trading kind of thing than it is necessarily a hedge when you actually go to spend it. So that's kind of a paraphrase on that. But, like my dad's saying, you're not going to take a bar of gold and then go to the grocery store and go, okay, give me 12 pieces of bread. Like, what kind of change are they going to give you? Right? So it makes it hard to have that be spendable to you as far as that being that way. Now, can you use it as a commodity if all the crap hit the fan and you needed to use gold?
That's a
Yeah,
different
but
name.
again, what are you going to do? Give your neighbor like, hey, I need toilet paper and bread and whatever. Like, it's kind of a barter kind of thing if you think of it in that regard. Really, its value is whatever it can be used for. And so if your use for it is limited, then it's going to be tough. Like, anyway, so just kind of as a side note there. Now, right now, gold and silver tends to be going up. And so as far as like value of it going up, again, if it's not keeping up with inflation, then it's being devalued. So you want to just kind of keep an eye on all the things that you're doing, whether it's crypto, whether it's gold and silver, whether it's bonds, whether it's your mutual funds. You want to be able to see, is it keeping up with inflation? And if it's not going up, one of the benefits that we like of the policy is it has guaranteed increases. And so you know that it's always going to go up. There is no such thing as a down market with the whole life policies because it does have a guaranteed increase. And so it allows you to be able to know that it is always going to go up. That helps to hedge the other things that might be volatile. And so as far as your portfolio goes, that allows you to be able to have multiple things that you can look at and not just feel like you have to do gold and silver, which is more of like a commodity kind of thing, or bonds. The policy can kind of give you that same thing, but give you more of a benefit, and you don't have to wonder if the value is going to be up or down or where it's going to be because it's always going to be going up.
And I would suggest to you that gold and silver are really speculative investments. Okay. Because I mean, you're buying it with the idea that it's going to go up. I mean, again, there's two reasons to buy it in my mind. One is like Christy's talking about, when the end of the world comes and you need to eat, gold is a good thing to have. Should you have everything you have in gold? No. Should you own some gold? I'm not opposed to that, but realize that it's a commodity, as Christy says, and it's a speculative investment. It should not be considered an investment. And by the way, the other thing I think that sometimes gets confused with an investment is your home. I don't think your home is an investment. I think it's a place to live. Okay. Because, okay, I was talking to a woman today. She owns a $400,000 house. She's thinking about maybe selling the house and going and traveling. Okay. Well, if you sell the house and buy another house, guess what? That you buy it at a certain level and you buy another house, it's also going to be inflated. So it's not really an investment in that classic sense of the term.